But the Fed was not the only central bank in news last evening. Bank of England hiked rates for the first time in a decade to 0.5% from 0.25%, led by Governor Mark Carney. The Monetary Policy Committee voted 7-2 in favor of a rate hike. This move removes the emergency stimulus introduced after UK voted to exit from the European Union. The pound, however, slumped after the commentary accompanying the rate hike. Most market commentators believe that more rate hikes could be on the way, could be some time away. And this is in line with what has been seen across the major central banks. A slow, extended withdrawal from monetary policy accommodation is what appears to lie ahead. What does this mean for financial markets? What does this mean for currencies and treasuries across the board? Vishnu Varthan, Head of Economics and Strategy at Mizuho Bank, joins us from our studios in Singapore. Vishnu, thank you so much indeed for joining us. Let me begin this conversation about what you thought of what central banks are doing at this point. You've got a new Fed chair. You've seen the Bank of England hike interest rates. Is this in line with what the market is working with?
Yes, I think broadly the theme is in line with what the markets are working with. I mean, the markets are working with two things. One is continuity in the Fed's policy, even if it's going to be a very gradual move as they wind down their balance sheet in a very glacial pace. So nothing too disturbing. At the same time, I think the markets are also looking at the big convergence theme playing out. That's to say, people like the Bank of England, Bank of Canada, the ECB, closing the gap with the Fed in terms of what was previously policy divergence. What is worth noting here is, I think earlier this year, somewhere in August, September, markets got a little bit ahead of themselves in betting on the convergence theme. So they started selling off the dollar, buying up the euro, sterling, the CAD. Right now, it's a bit of a pause to look at whether these are the right bets. And accordingly, we've seen the CAD decline. And the latest, like you rightly pointed out, the sterling decline, because they don't see the next few hikes coming in this so-called usual cycle fashion. It's going to be ad hoc and when the recovery comes through.
What then is likely to happen to the dollar in the near term, Vishnu? Because, you've seen some weakening that the dollar is facing against the yen and the emerging market currencies. Is that trend likely to continue?
I think if you take a broader view of this, we are big believers that the convergence theme will play out into late 2018, early 2019. And so a bit more moderation in the dollar is certainly due. But nothing ever moves in a straight line. And I think because the convergence bets are overbaked, what we will see is a period of dollar volatility. What would really lead to the volatility is because apart from monetary policy, on a parallel track, you've got Trump policies running. So, with tax reforms, you've got disappointments, hopes, so on and so forth. And so we'll see a little bit of volatility. But what we are anticipating is in the next 6-month window, we will probably be seeing a bit more dollar strength making a comeback before the dollar moderates again as major central banks get back onto the tightening theme. But not quite yet. I think the dollar weakness theme this year is a little bit overdone. When
you were talking about the dollar, you are the third most accurate rupee forecaster in Bloomberg's quarterly ranking for the third quarter. How are you feeling about what the rupee is doing in the context of what the government has done? And let me split this into two questions. One, in the first half of this year, you saw the rupee swing one direction. In the second half, you saw the rupee swing in another direction, and now you're seeing a bit of choppiness. What's going on in the dollar rupee equation?
Well, to be very honest with you, I need to reorientate myself as well. I think when we moved into the post-demonetization report from the RBI, and we saw a bit of populism creeping in, farm debt waivers, widening of current account deficit. Cyclically, I was beginning to turn less bullish on the rupee, at least in the near term. I was thinking rupee outperformance on a relative basis is going to be tempered. The dollar theme would be the big one. But the bank recapitalization has been a big positive. So we are thinking of how to play the rupee story out. We're still looking at 12 to 18 months rupee going below 64, 63, testing 63 as we look at the big dollar moderation coming in. But near term, we don't want to rule out rupee testing above 66. It does look like a long way from here. But the warning shot really is when the current account and fiscal deficits are set to widen, any up move in the dollar, any dollar surge could take out not just the rupee but most Asian currencies by a little bit of surprise. So that's the surprise element we are pricing in. As with whether this is accurate or not, I'll be the first to tell you it's entirely luck.
So I hear you loud and clear. But just to sort of push that point a little more, your year-end forecast of 65.80, does that stay? And you're saying in the near term the support could be anywhere between 66, 67. Am I getting that right?
Absolutely, yes. So near term, we are looking at nothing too outlandish, not too much tail risks. But as we are looking at the dollar, depending on exactly how these tax reforms play out and how the convergence trades unwind, we are pricing in a possibility that the dollar rebound could be a little bit stronger than anticipated, catching the rupee a little bit wrong-footed as the current account deficit is wider and it's not in the perfect spot that it used to be, where it had very, very narrow twin deficits and everything going right for it. So getting into the election cycle, I want to temper my rupee optimism. I am a longer-term rupee bull. But for now, I think I'll just sit by the benches and wait and watch.
There's another interesting theme also playing out, Vishnu, that while people have turned bullish on stocks and perhaps on the currency as well, there is a sense of bearishness that's crept into the fixed income market. People believe that there is going to be fresh supply of paper given the bank recap plan. Would you agree?
Well, I think that, the bigger theme that I want to play out is if you think about real rates really bottoming out as inflation rises, I'm bound, I've got a bit of a proclivity to agree with the rates market saying that, look, the yields have to go a little bit higher, so it does look like the overall equation does look less attractive than it used to. But having said that, because there are a lot of limitations on foreign buying ownership, be it with bonds or equities, and the longer-term India story tends to be a very, very compelling bullish story. People who are already in are reluctant to get out. So I'm not so sure that the yield move upwards is going to be brutal because people making their way to the exit may want to consider whether they want to or not, and they rather hang on for the longer term. So I'm acutely aware of the supply-demand dynamics due to the limitations. So it's a bit like buying a branded good. High price doesn't matter. People still get in. So low yields is not justified by fundamentals, may not deter because they see the longer-term value in it, the exclusivity value in it.
Okay, so very quickly, so you're suggesting that the yield on the 10-year paper will perhaps stay at these levels without tapering lower?
Well, I think the yields are going to start rising somewhat. I mean, that's going to be a function of the fact that returns are not looking as good and inflation is going to start edging higher. So it would go a little bit higher, but I think in terms of thinking that the bond papers are going to sell off because a lot more supply is coming on, that fear may be a little bit overdone. I think the demand is there and it's something that would be a bit stickier, particularly for the foreigners who want to hold on to Indian paper.
How would you comment about foreign investor fund flows? Again, there's been an interesting trend in here in India where on the equity side, you've seen significant amount of FII money for the first half of the year. For the last 3 months, you have seen significant outflows. The month of October alone, we saw about $1 billion that went out, came back on the day when bank recap was announced. On the other hand, you've seen mutual fund money, which is, the domestic money has been pretty strong. On the debt side, there's been the flow has been steady and most of it has hit the limits as well. Do you anticipate fund flows to remain equally strong for the rest of the financial year? Will bank recap sort of attract more money coming on the debt side?
Given the very flush global liquidity conditions and the fact that major central banks are not going to revoke that in a hurry, and we're in a low interest rate world, I think the compelling nature of India's growth story, as well as the relative credit ratings versus the returns that you're getting, just to give a comparison, if you're looking at real returns in Indonesia versus India is a much more compelling story for me. And the natural limitations on how much foreigners can buy keeps them wanting more. So I'm not so pessimistic about fund outflows, on a more permanent basis. But certainly we're not ruling out the bouts of shocks that can come through, particularly if the dollar turn catches I think markets a little bit off guard.
Vishnu, we'll leave it there. Thank you so much indeed for joining us. Vishnu Varthan from Mizuho Bank, giving us a sense of where what foreign investors are likely to do, what that means for Indian markets, Indian currency as well.